If you've spent any time researching property in Sharjah, you've probably seen the same promise over and over again. 7%, 8%, 9%, sometimes even 10% rental yield. And if you're like most investors, you've probably had the same reaction. There's no way that's real. Because when something looks significantly better than what you're used to seeing, it's natural to be skeptical. After all, in many Dubai communities, investors are happy with rental yields somewhere around 4% to 6%. In cities like London, Singapore, and New York, many investors are working with yields closer to 2% to 5%. So, when Sharjah starts showing numbers that seem almost double that, it's hard not to raise an eyebrow. Are those yields actually real? Or are they just marketing numbers designed to attract buyers? Well, the answer isn't as simple as yes or no, because some of those numbers are absolutely real. But they're also not the whole story, and that's where many investors get confused. I think this belief exists because people naturally compare Sharjah to markets they already know. When investors see 8% or 9% yields being advertised, they immediately compare them to Dubai, London, Singapore, or wherever they've invested before. And honestly, that's a reasonable thing to do. The problem is that not all markets behave the same way. Dubai is a very different market. Property prices are generally higher. International investment activity is stronger. And many investors are also focused on capital appreciation. Sharjah, however, operates differently. Property prices are often significantly lower, yet rental demand remains surprisingly strong. And that's what creates the yield difference. But before we go further, we need to talk about the biggest misunderstanding of all. This is where many investors accidentally get misled. Most listings advertise gross yield, not net yield. And there's a big difference between the two. Imagine you buy a property for 800,000 dirhams, and that property generates 64,000 dirhams per year in rent. On paper, that's an 8% rental yield. Sounds fantastic, right? But that's not necessarily what ends up in your pocket. You still need to account for service charges, maintenance, leasing fees, vacancy periods, and occasional repairs. Once those costs are deducted, that same property might produce a net yield closer to 6%, 6.5%, or 7%. Now here's the important part. That's still a very healthy return. The issue isn't that the advertised number was fake. The issue is that many investors stop calculating after they see the headline. And this is where the conversation becomes more interesting. Even after adjusting for expenses, Sharjah still produces some very attractive yields. In many established communities, investors continue reporting rental yields between 6% and 8%. And by global standards, that's strong. Think about it. If an investor is receiving 2% to 4% in some major cities, 4% to 6% in many established markets, and potentially 6% to 8% in parts of Sharjah, it's easy to understand why people are paying attention. The yields aren't necessarily exaggerated. The market itself is simply structured differently. So, why does this happen? The answer is actually pretty simple. Property prices remain relatively affordable. At the same time, rental demand remains active. Let's look at an example. A family apartment in Sharjah might cost somewhere between 700,000 and 900,000 dirhams. A similar-sized unit in parts of Dubai could easily cost 1.2 to 1.8 million dirhams or more. Now here's the interesting part. The rental difference isn't always proportional to the price difference. That's what creates stronger yields. Because rental yield isn't about how much rent you collect. It's about how much rent you collect relative to what you paid for the property. Imagine two investors. Investor A buys a property for 750,000 dirhams. Investor B buys a property for 1.5 million dirhams. Both properties generate 60,000 dirhams in annual rent. They're earning the exact same rental income. But Investor A is achieving roughly an 8% gross yield. Investor B is closer to 4%. Same rent, completely different return. And this is one reason Sharjah continues attracting yield-focused investors. Not because rents are unusually high, but because purchase prices remain relatively accessible. Of course, not every area performs the same. And this is where many investors make mistakes. They hear an average yield number and assume every property can achieve it. That's simply not how real estate works. Communities like Muwaileh, Aljada, Nahda, Khan, and areas near University City often benefit from strong rental demand. Why? Because they attract students, working professionals, families, and commuters. Take Muwaileh as an example. Its proximity to schools, universities, and major commuting routes helps keep rental demand active throughout the year. On the other hand, communities like Maryam Island attract residents for very different reasons, such as waterfront living and lifestyle amenities. Even within the same city, demand drivers can vary significantly. That's why one property might achieve an 8% yield while another struggles to reach 5%. Location matters, but understanding who wants to live there matters even more. Another important factor is demand. Sharjah is now home to more than 1.8 million residents, and that number continues to grow. Many people choose Sharjah because they can often get more space, larger units, and lower living costs. Meanwhile, Dubai's property prices and rents have increased significantly over recent years. As a result, many residents start asking themselves, do I really need to pay Dubai prices? And for some people, the answer is no. That naturally pushes demand toward Sharjah. More residents looking for housing means higher occupancy, lower vacancy, and stronger rental performance. And that's one of the biggest reasons yields remain attractive. The short answer? Sometimes. If you see advertisements claiming 10%, 11%, or even 12% rental yields, it's worth asking a few questions. Are they using current rents? Future projected rents? Gross yields? Or net yields? Because those details matter. Some marketing materials focus on best-case scenarios, and there's nothing wrong with that as long as buyers understand the assumptions behind the numbers. But even after making realistic adjustments, many Sharjah properties still produce returns that investors would consider attractive. I think something bigger is happening right now. 5 years ago, many investors focused almost entirely on appreciation. Today, many investors are becoming much more focused on cash flow. They're asking, how much rent am I collecting? How stable is the tenant demand? How predictable is the income? And when investors compare 4% to 5% yields in some markets against 6% to 8% yields in parts of Sharjah, the conversation changes. Suddenly, Sharjah starts looking less like an alternative and more like a serious investment option. Not because the numbers are exaggerated, but because more investors are finally paying attention. So, are rental yields in Sharjah exaggerated? I think the answer is mostly reality, with a few important caveats. Yes, some advertised figures can be optimistic. Yes, investors should always understand the difference between gross and net yield. And yes, not every property will perform the same. But when you look at population growth, rental demand, occupancy levels, affordability, and transaction activity, it's clear that Sharjah genuinely offers some of the strongest rental yields in the UAE. The yields are real. The opportunity is real. Because the best investment decisions usually happen somewhere between hype and skepticism. In the next episode, we'll explore another common belief about Sharjah and find out whether it's myth or reality. If you've invested in Sharjah before, I'd love to hear about your experience. And if you're currently researching the market, let me know what surprised you most about today's discussion. Thanks for watching, and I'll see you in the next one.